What's going on, guys? It's Jimmy here. So, the Fed, the Federal Reserve, and Jerome Powell and the Board of Presidents, all the Fed presidents around the country, took a vote and made a vote here. And I'll let you hear directly from Jerome Powell about what they're going to do here for this decision and what they're expected to do here going forward for the rest of the year, which will affect your wallets and bank interest rates, credit card interest rates, mortgage interest rates, auto loan interest rates, savings interest rates, and a lot more. Take a listen here to what Federal Reserve President Jerome Powell has to say about our economy and more.
My colleagues and I remain squarely focused on our dual mandate to promote maximum employment and stable prices for the American people. We understand the hardship that high inflation is causing, and we remain strongly committed to bringing inflation back down to our 2% goal. Price stability is the responsibility of the Federal Reserve. Without price stability, the economy does not work for anyone. In particular, without price stability, we will not achieve a sustained period of strong labor market conditions that benefit all. Since early last year, the FOMC has significantly tightened the stance of monetary policy. We've raised our policy interest rate by 5.25 percentage points and have continued to reduce our securities holdings at a brisk pace. We've covered a lot of ground, and the full effects of our tightening have yet to be felt. Today, we decided to leave our policy interest rate unchanged and to continue to reduce our securities holdings. Looking ahead, we are in a position to proceed carefully in determining the extent of additional policy firming that may be appropriate. Our decisions will be based on our ongoing assessments of the incoming data and the evolving outlook and risks. I will have more to say about monetary policy after briefly reviewing economic developments. Recent indicators suggest that economic activity has been expanding at a solid pace, and so far this year, growth in real GDP has come in above expectations. Recent readings on consumer spending have been particularly robust. Activity in the housing sector has picked up somewhat, though it remains well below levels of a year ago, largely reflecting higher mortgage rates. Higher interest rates also appear to be weighing on business fixed investment. In our Summary of Economic Projections, or SEP, committee participants revised up their assessments of real GDP growth, with the median for this year now at 2.1%. Participants expect growth to cool, with the median projection falling to 1.5% next year. The labor market remains tight, but supply and demand conditions continue to come into better balance. Over the past 3 months, payroll job gains averaged 150,000 jobs per month, a strong pace that is nevertheless well below that seen earlier in the year. The unemployment rate ticked up in August, but remains low at 3.8%. The labor force participation rate has moved up since late last year, particularly for individuals aged 25 to 54 years. Nominal wage growth has shown some signs of easing, and job vacancies have declined so far this year. Although the jobs to workers gap has narrowed, labor demand still exceeds the supply of available workers. FOMC participants expect the rebalancing in the labor market to continue, easing upward pressures on inflation. The median unemployment rate projection in the SEP rises from 3.8% at the end of this year to 4.1% over the next 2 years. Inflation remains well above our longer run goal of 2%. Based on the Consumer Price Index, or CPI, and other data, we estimate that total PCE prices rose 3.4% over the 12 months ending in August, and that, excluding the volatile food and energy categories, core PCE prices rose 3.9%. Inflation has moderated somewhat since the middle of last year, and longer-term inflation expectations appear to remain well anchored, as reflected in a broad range of surveys of households, businesses, and forecasters, as well as measures from financial markets.
Yeah, so Federal Reserve Chairman Jerome Powell, you can see here, Federal Reserve leaves interest rates unchanged this time at a 22-year high, but they signal there will be at least one more rate hike in 2023. So they signal they're not done raising interest rates, even though interest rates are at a 22-year high already. Yeah, you guys can let me know your thoughts on this. And they signal they're not done yet. The economic pain is not enough yet. They're going to raise interest rates yet again this year. This sent the stock market nosediving. This sent the stock market from up in the green to negative red almost instantly. Yeah, you can see the S&P 500 instantly tanked down to the red, down 1%. The NASDAQ, same thing as well, down 1.5%. Of course, this is only one day, so take that with a grain of salt. Again, if you're a stock market investor, you should be a long-term investor. But yeah, so they're going to be raising interest rates here yet again this year, at least is what they're signaling. And honestly, it looks like on the news, this actually sent up mortgage rates even higher. You can see here, 30-year mortgage rates at 8.05% here. Remember, the average house prices are at $400,000. We'll look at California here, the largest population state, 8.06% for credit scores between 700 to 719. 8.06%, the average 30-year fixed mortgage rate now. Unbelievable. Again, these are at 22-year highs, and the Fed says they're going to raise interest rates yet again in 2023 potentially. Wow, absolutely a nightmare here. You guys can let me know your thoughts here in the comments. Texas at almost 8.1%, 8.093%. How much higher can we go? Are we going to go back to double-digit mortgage rates? Wow. And God bless you, if you have a 600 score and the average credit card interest rate, this will be just the next excuse to raise credit card interest rates here yet again. The average credit card interest rate here ending this week, the average credit card interest rate is over 28%, according to Forbes weekly credit card interest rates. Unbelievable. Unbelievable. And it seems like everything just keeps going up and up and up, including the U.S. national debt, which now hits $33 trillion for the first time. U.S. federal debt hits dangerous new milestone, as if 32 trillion or 31 trillion wasn't dangerous as well. U.S. national debt hits $33 trillion for the first time. As the Fed keeps raising interest rates, this is also raising the amount of money the U.S. government pays on their interest on the $33, at least whatever is not locked in. Because remember, some of this interest also gets, when it comes due for to be adjusted or, comes up for, new rates. Also, the U.S. continues to pay record high interest rates on the $33 trillion as well, costing more taxpayer money on the $33 trillion in debt as well. And I always get the question, who is the $33 trillion owed to? Well, it's owed to a lot of different people. Some of it's owed to foreign countries like China, Europe, Mexico, all over the place. Some of it's actually owed to you guys, believe it or not. If you own any index funds or any bonds, you actually might the government actually might owe you money, believe it or not. Yeah, so if you own, as I just said, any index funds or bonds or any U.S. Treasuries, the government owes you money. Yeah, believe it or not. hmm Yeah, and yeah, as these rates go up, the government pays you money through that. Yeah, and Social Security is actually kind of a roundabout way, actually, as well. Yeah, Social Security is held in U.S. Treasuries, and then you get your Social Security with interest back through it. Social Security. Social Security is a little bit different than the Social Security debt. It's somewhat a little bit different. Yeah, but it's technically debt per se with the interest, but yes, but no. It's a long story for a different video, maybe. But yeah, so if you own any bond funds or anything like that, chances are you actually own US government debt or municipal bonds or something like that, state debt or something like that, county debt, something like that. And yeah, chances are you're earning more money on those because interest rates have gone up. If you have money in a bank, you're probably earning more money on those. Although regional banks and stuff like that might not be paying you more money in a savings account. Those are pretty low. If you go to an online bank such as Vanguard is a very good place to have your money. Vanguard, a multi-billion-dollar bank, pretty much the best of the best. Again, not financial advice or anything like that. I'm not a financial advisor or your financial advisor or anything like that. But you can get over 5% on a money market account there. I'm not sponsored by them or anything. Um, but yes, and then you can basically just withdraw your money, get it back a day or two later. Yeah, or you can shop around. Shop around. But again, make sure it's FDIC insured in something like that. A money market account is basically like a savings account or a CD, but a CD locks in your money. So 3 months, 6 month, year, 2 year, 3 year, but you might want that. You might want that to lock in those higher rates for a longer time. A money market is basically kind of like a checking account where you can get your money back a day or two later, and they'll send the money to your actual checking account. Okay. On the other hand, the rates are higher, but they're not locked in. Okay. So hope that kind of makes sense. Yeah. So let me know your thoughts here in the comments. That's where you can kind of benefit from the higher rates right now. So there is a little bit of pros and cons there. But for the most part, these high rates are really hurting America, mid America, average and low middle income Americans and businesses as well. Borrowing money is at the highest it has been in 20 plus years. So I'll keep you up to date here. If you haven't yet, subscribe down below, click the bell icon so you don't miss out on any new videos. Thanks for liking and sharing these videos with anybody that needs to hear this information. Share it on Facebook, Twitter, or anywhere that anybody needs to hear this. So click here to see what could lead to World War III, or click here to watch our newest video next. Thanks for watching, guys, and I'll see you in the next video.